Hi all, Stephen Dooley here. Thank you very much for joining the webinar today. Excited to be able to present to you in our final webinar for the year. We'll give it another minute or two and let everyone join, and then we'll kick off in a moment. Thank you. Okay, everyone, thanks very much for joining the call. It's a couple of minutes past 3 o'clock, so we will kick off. Like I say, this is the final of our monthly Global FX Outlook webinars, which we've been able to join and host for you this year. And we hope that you found them useful each month. In the first week of each month, looking at what the big drivers are, and our forecast to provide you with an up-to-date view of the global markets. My name's Stephen Dooley. Like I said, I'm the head of market insights here at Convera, and I'm really pleased to have Boris here again, our global macro strategist from Austria, calling in. Thanks a lot for joining today, Boris.
Pleasure to be here. Thank you, Stephen.
Okay, well, let's all kick off, and a couple of points of housekeeping. Best to be full screen and seeing the slides that we have to present with you today. We'll take questions at the end of the session, and again, the recording will be made available for everyone who has attended today and everyone who has registered as well. So November has been a really significant month in financial markets, really driven by the expectations that the Federal Reserve in the United States is now on hold and unlikely to continue to raise interest rates. So that's been the dominant theme all throughout markets in November. We saw equity markets strongly higher, the S&P 500 up 8.9%, actually the best monthly gain for the US benchmark share index since July 2022. We saw bond yields fall substantially. The US 10-year bond yield fell from up above 5% at the start of November to well and truly below 4.5 by the end of the month. And we saw gold, along with other markets, skyrocket. Gold actually hit an all-time high just yesterday of 2,135. But for us in foreign exchange markets, what the big driver was, that big fall in the US dollar. The US dollar index fell as much as 4% in index, its biggest monthly decline since November last year. And as I say, entirely driven by expectations that the Federal Reserve is now on hold. It's an interesting story because, of course, we have been here before. At the moment, there's over 125 basis points worth of cuts. So 5 full interest rate cuts priced in to the US Fed funds futures market. But as I say, we have been here before. The year started with markets expecting 4 rate cuts from the Federal Reserve. And of course, after a couple of hot inflation numbers, those expectations for rate cuts were completely eliminated. Equity markets fell and the US dollar staged a strong recovery. So One of the concerns as we enter December is, has the market got too far ahead of itself in these expectations that the Fed's not just finished with hiking rates, but also likely to cut rates next year? Of course, with the US dollar weaker, we saw some big moves in key markets, and the British pound had a very strong recovery. The pound US dollar pair jumped only 3% away from 18-month highs, and pretty close to its post-Brexit vote average at 129. So a good opportunity out there in the UK for those US dollar buyers using pounds. The euro is also stronger as well, hitting 3-month highs. Didn't hit quite the same extreme levels of highs that we saw in the British pound, and that's because we got a quite unexpectedly sharp drop in November inflation from the euro at the end of the month. Eurozone inflation fell from 2.9 down to 2.4, quite a sharp fall, and also hit the euro's valuation as well. But probably the standout currency in November was the Australian dollar. A bit of perfect storm for the Aussie, and it got close to 4-month highs. The Australian dollar was the largest beneficiary, partly because as equity markets go higher, the Australian dollar tends to outperform. It's very sensitive to an improving risk sentiment. But we also saw some better data from China. The Chinese yuan was stronger last month. That helped the Aussie dollar. And then finally, of course, the Reserve Bank of Australia raised rates in November by 25 basis points to 4.35. That was the 13th hike from the RBA. And with most central banks now looking like they're on hold, the fact that the Australian central bank looked like an outlier, one of the few central banks to raise rates last month, helped the Aussie higher as well. So that's where we stand at the end of November. The US dollar sharply lower on expectations the Fed has finished hiking rates. The pound much stronger. The euro higher, but capped somewhat by that inflation number. And the Australian dollar, the real outperformer. Like I said, the big risk as we enter December is, have markets gone too far too fast? We've been here before where markets believe the Fed is about to cut rates. They didn't. Instead, they raised rates, and that saw equity markets lower and the US dollar stage a big comeback in 2023. What's the outlook for December and for 2024? Well, I'll pass over to Boris now, and he'll give us the latest update on the macroeconomic landscape. Boris.
Well, thank you very much, Stephen, for this nicely setting the scene. And of course, a warm welcome to everyone joining as well from my side. As you perfectly summarized in the beginning, we are just coming off from one of the best months for risk assets in almost 3 years. And as always, my part of the presentation and my contribution will be about explaining these drivers behind this capital rotation into equities, into bonds, and away from the US dollar. And we will also have a brief look ahead into December to answer the question of how likely this trend is to continue. It is important, as you mentioned before here in this slide, to just remind ourselves of that global investors came into November against this quite negative backdrop from a risk perspective. US macro data had been incredibly strong in the previous months, and hawkish Fed speak had pushed up US government bond yields for 6 consecutive months. And the US 10-year, as you said, had reached a 16-year high at around 5%. And this drastic move pretty much set the tone for the rest of financial markets going into November. The euro, the Aussie, and the pound had been falling for quite some time, and the global equity index had pushed lower for 3 consecutive months. However, as you already noted, November has been really the best month for risk assets this year, in what some have called a brought forward Santa Claus rally, because European and US stocks had recorded 4 consecutive weekly rises in November, against this backdrop of not only falling stock market volatility, but also falling bond market volatility. And bond yields across the board, as we can see here, and across countries as well, have fallen significantly, most notably, again, the US 10-year government bond yield, the bloodline of the global financial markets, coming down from its 16-year high at 5% to now just below 4.2%. And for this obviously begs the question of what really happened to turn this gloomy outlook in October completely upside down in just a matter of few weeks. And for us, it's really about these three developments in particular that have been responsible for the US dollar falling and for global stocks pushing higher. So the first one that we mentioned is US, Eurozone, and UK inflation surprising to the downside. Just on the first slide still, Stephen. Signs emerging that the US labor market is cooling, and then G3 central banks deciding not to raise interest rates at their last meeting. And this led to the largest drop of the Goldman Sachs Financial Conditions Index in the US in recent history. This is how significant these three events really were for markets, because taken together, investors have felt more comfortable to start pricing in significant rate cuts from the central banks, not only from the Fed, as you mentioned, Stephen, but also from the European Central Bank and for the Bank of England going into 2024. Even with these policymakers really pushing back loudly against any speculation that they would ease monetary policy going into next year. So with this kind of backdrop, with this setting in mind, let's look at those three drivers of the risk rally more closely. And we can start on the inflation front on this page, because again, zooming in on our first chart here, from a global perspective, we can see that the current inflation rate is at or near two-year lows in most countries we're looking at. And while we're still some distance away from pre-pandemic levels, which we have highlighted here at the bottom of the red bars, the recent progress made in the fight against inflation has really been welcomed by not only investors, but also policymakers. The latest acknowledgement of this narrative has come in the form of the latest inflation prints last week, with US and Eurozone inflation falling to 3% and 2.4% respectively. The magnitude of this disinflationary trend has, however, varied across regions, with inflation, for example, in the UK and in Australia still quite elevated at 4.6 and 5.4%, which in our opinion is why the pound and the Aussie dollar have outperformed the broader FX space. But we'll hear more about this one in Stephen's section. On the next slide, we can see the second development in kind of the context of driving the risk rally in November, which has been the easing of labor markets and more broadly kind of the weakening of economic activity. Because we have noted that labor markets in most countries still remain incredibly tight, with unemployment rates now just below their 20-year averages. However, as the economic cycle starts turning and the weakness from the pro-cyclical parts of the economy, think about the manufacturing sector, global trade, the global property market, when those kind of start to spill over into the services sector and labor markets, and secondly, if these higher interest rates start taking effect, this is when we are expecting the consumer to weaken going into 2024. This is still not fully visible, as I said, in the lagging data, as we can see here, because the unemployment rate in the US, in the UK, in Germany, has so far only risen by around 40 to 50 basis points. However, most leading indicators are pointing to further weakness ahead. Just to name the most important leading indicator in this kind of context that we have gotten in the last couple of weeks, we got the release of the Purchasing Manager Index for the US and for the Eurozone last week. And the sub-component of these surveys that tracks the development of employment fell into negative territory for both regions, which is normally something only happens during recession and something that precedes the rise in the unemployment rate. And I think this brings us neatly into our last market driver on the next slide, because as economic data has started disappointing expectations in those major economies, so have the implied probabilities of these central banks hiking interest rates in December fallen to basically 0%. And we can see in this chart, for example, how the global tightening cycle is coming to an end, with 2024 really shaping up to be a more accommodative year for from a monetary policy perspective. Not only have major central banks decided not to raise interest rates in November, as Stephen mentioned, markets now price in more than 500 basis points of cuts from the BOE, from the Fed, and from the ECB over the next 24 months. So these kind of three developments have been key in shaping November for us, because as we mentioned numerous times on the next slide, the last month has been really a remarkably strong one for global equities and for risk assets in general. Equity benchmarks, for example, for Germany, the Eurozone, the US, UK, France, they are all between 0.5 and 5% away from reaching all-time highs. And implied stock market volatility on both sides of the Atlantic has fallen to post-pandemic lows last week, given this expected easing of monetary policy. In the US, for example, the equity rally is definitely broadening in space, even though the tech stocks are still the largest driver of the recent move higher in the benchmark index, because the year-to-date performance of important companies like Microsoft, Apple, Nvidia is around 45 to 70% this year. And they have clearly outpaced the overall index. The S&P 500, for example, is up around 20% this year alone, but 75% of these gains come from just 7 companies, which are famously known as the Magnificent Seven. Excluding these companies from the benchmark gives us a sobering year-to-date performance of just 4.8%. Looking more broadly across assets, Stephen mentioned it as well, gold hit a new record high this week as yields on fixed income products like government bond yields have fallen, and Bitcoin hit a 20-month high above 41,000 based on this strong sentiment and positive news surrounding a new Bitcoin ETF being potentially approved. So this has really been an everything rally as investors have cheered the peak of these interest rates. So going on to the next slide and kind of trying to answer the question on the look ahead into December, we can once again highlight our 3 drivers of the November rally that I have mentioned previously. And we can simply ask, are these themes likely to continue going into December? Because if they are, if central banks are done raising interest rates, if the US economy slows at a moderate level like it did in November, and if inflation numbers continue coming down, then the equity rally probably has some room left for improvements, and the dollar will remain on the defensive. However, if some of these assumptions don't stand the test of time, and especially don't stand the test of data, some correction to market positioning is expected to occur. And the good thing for us is that the whole of December, or at least the first 3 weeks of December before the holiday season starts, will give us plenty of opportunity to answer those questions with, again, a lot of data coming up. The first theme that we see here in our calendar is the monetary policy theme, because the major central banks will meet again in December for their last policy setting of the year. And while we do not expect any changes to the policy rate in the US, in the UK, and in the Eurozone, there are some important factors that we'll be looking at. And one of them is the publication of the projections on inflation, on interest rates, and on economic growth from these central banks, because this is kind of the last information they can give markets to guide them into their thinking going into 2024, especially given that policymakers are still vividly pushing back against these rate cutting speculations from markets. The second thing is, again, the labor market. We've talked about it, and the lagging nature of the unemployment rate. The next US non-farm payrolls report, one of the most important market drivers, especially on the FX side, comes out this Friday. And again, will be highly important, especially given that the November risk rally that we have been talking about has been partially fueled by US jobs growth actually coming in well below the consensus in the previous month. So the US economy added around 150,000 jobs to its workforce last month, and economists are now expecting a slight pickup to 180,000 in November. So this could be kind of the first test of the risk rally. And lastly, secondary data points will also be crucial to kind of gauge how much central banks will actually cut interest rates next year, especially given how sensitive and data-dependent policymakers and therefore markets have become. So retail sales in many different countries, industrial production numbers, and also the purchasing manager indicators will all be closely watched as well. The inflation print on the 20th in the UK will be the main macro event of the month for the country, due to, again, inflation continuing to be much higher than in other parts of the developed world. And this, as we said, has partially explained the pound recovering some ground versus the euro and the US dollar. So it will be interesting to see if this diverging inflation trend between these countries can really hold. So we'll be having more of these data points to come in December. In terms on the next slide of our kind of main narrative going into this eventful period, I would say that markets are currently really priced for perfection. And that could be a risk in and of itself, because markets are both positioned for a soft landing in the US and for the Fed to cut interest rates. And normally these two conditions wouldn't really be compatible with each other. But because US data has weakened enough for investors to price in these rate cuts, but is not weakened enough to cause a real panic, this Goldilocks environment had been upheld in November. So if this narrative prevails, risk assets, as I said, the pound, the euro, and the Aussie dollar would continue to outperform. However, if US macro data starts going from just bad or worsening to outright recessionary, then the soft landing narrative will fall. At the under end of the spectrum, if US data starts outperforming expectations by a large margin, this will put the chances of rate cuts into question. So both scenarios where US data outperforms or is much weaker than expected, for us would lead to more market volatility going into December, especially given the currently suppressed levels of volatility and the complacency of investors. We think that the first scenario of the US economy continuing to slow is currently kind of the more likely one, because of kind of this setup that we went into November, because two things have kept the US out of recession this year: the incredibly strong US household and elevated consumer spending on one side, and companies being insulated from the Fed's tightening cycle on the other side. Because US corporate interest expenses as a percentage of cash flows have fallen to a 40-year low at 5%, when the average rate since the 1980s was around 17%. And this is just due to the reason of how much companies have borrowed during the low rates environment and just the pandemic splurge. And this is why the average interest expense and why the rate sensitivity of US companies has actually decreased to an all-time low. However, as we said, the longer the Fed and other central banks keep up interest rates, the more will companies feel the effect of this tighter policy, which is what explains our below consensus forecast on not only global growth going into the first half of 2024, but also US economic growth. Going from the macro side to the FX side, investors are currently in the game of assigning a hierarchy to G10 central banks based on their likelihood of easing policy in 2024. And the more rate cuts are currently priced in, the more the currency is expected to weaken going forward. So the Fed and the ECB have kind of led the pack in this regard as of late, followed by the Bank of England. The Australian Central Bank is expected to maintain policy throughout 2024, which is one reason why the Aussie dollar has been so strong versus its peers. So this is, I think, a prime example on my end of how macro shapes FX and why we start our global webinars with the global overview before diving into our currency outlook. And I think with this information in mind, with this backdrop, I can hand over to Stephen again, who will walk us through our FX calls.
Thank you very much, Boris. That was great. Really enlightening. Thank you. And absolutely love that term you used, the everything rally. Just can't overstate how monumental the move we saw across financial markets was over November. And I already mentioned the US 10-year bond yield, the most important financial instrument in the world, falling from above 5% at the start of November down to 4.22% now. The US S&P 500 up almost 10% in a month, up 8.9% an incredible move. And like Boris was telling you, the gold price jumping from around 1,800 US dollars per ounce to a all-time high yesterday of 2,135 US dollars per ounce. So those falling interest rates just drove a rally in everything. And like Boris said, it means that markets are now priced for perfection. Are things really too good to be true? Well, that's where we have to really identify that sometimes managing foreign exchange, well, a lot of the time managing foreign exchange isn't about predicting the future, it's about identifying the risk. And clearly, the big risk out there at the moment is that maybe things won't be too good to be true. And how will markets react if that is the case? What if the US economy slows by more than expected? What if we don't get a soft landing? What if the Federal Reserve, like we've seen previously, doesn't come through with market expectations for rate cuts? What if rates need to stay higher for longer? In both of those cases, it can have a really big impact on FX. So let's have a look at where FX is currently sitting and how it might play out over the next couple of months. Like we mentioned at the start, both Boris and myself discussed is that bond markets have actually seen volatility fall, but they've still seen big moves, and that's because the moves have been predictable and in one direction to the downside. So it's been these bond yields that have really driven the big moves in APAC so far, well, in November. And the biggest move, the Aussie yen. Now, the Australian dollar Japanese yen pair tends to be highly sensitive to risk to risk sentiment. And so as equity markets go up, the Australian dollar tends to go up versus the Japanese yen. And that's what we've seen so far in November. What's interesting is that the Aussie yen has actually seen a pretty quiet year in terms of volatility. So far, year to date, the trading range has been 14.6%. On average, it's about 21%. So if we don't see another 7% or 8% move on the Aussie yen by the end of the year, it's going to be a much quieter than expected year in the Aussie yen. But regardless, you can see also that within the range, right at the high of the 3-month highs, right at the high of the year-to-date highs. So the Aussie yen really just redlining at the top as a result of those higher equity markets. And in general, the Aussie yen tends to be very sensitive, very correlated to what goes on in equity markets. As equity markets go up, people tend to buy the Australian dollar for their yield advantage, so it tends to move in line with equity markets. The other two big moves that we want to draw your attention to, the Kiwi US and the Aussie US, the other big moves up a range of 5.9% for both the Kiwi US and the Aussie US over the last 3 months. And again, as the US dollar fell, the Kiwi and the Aussie, two of the best performing currencies for the last month, again, because they are more closely tied to global growth expectations, and they're also more closely tied to risk sentiment and that yield differential as well. To the downside, where we've seen less movement in the dollar CNY, that still moved quite a large amount compared to its historical bias. Historically, the dollar CNY has moved about 6% per year. You can see it's moved almost 10% per year already. So more volatile than usual, with some big moves in the CNY, and the Chinese yuan strengthened quite significantly over the last couple of months. You can see it's right down the bottom here of its 3-month range. And the dollar Sing as well are really seeing quite a quieter than usual year with a 5.7% range year to date on average, the dollar Sing has traded in a 9% range since 1986. So in general, volatility lower than usual right throughout markets, maybe not as a result of it, not in the dollar CNY, but in other markets, less volatility than we're used to seeing so far this year. Where's the value? Well, we already discussed that the Aussie yen are right at the high of its long-term range. Look at that versus its 5-year average, up 18% versus its 5-year average. So the Australian dollar really outperforming. It's near 8-year highs versus the Japanese yen. Other points where we can see value, well, overall, the Aussies had a good month, but a poor year. So even after a big rally, you can see in general, it's still below most of the key moving averages. It's flatlining versus the Aussie in the Aussie CNY and the Aussie CAD. But as you look lower, over 1 year, down 1% versus the Sing dollar, down 2% versus the euro, and down about 3% versus the British pound. Versus the US dollar, year to date, it's bounced back towards its year average, but still historically quite down on its longer term average, down 3% versus its 2-year average, and down 5% versus its 6-year average. So for now, clearly looking at this, what it tells us is the Australian dollar remains at a quite low valuation compared to its historical averages. Okay, what does this mean for the Australian dollar over the short term? Well, as I said at the start of this section, thinking about financial markets isn't necessarily about predicting the future. It's about identifying where the risk is. And with the Australian dollar having spent most of the year under 65 cents, after a big pop higher, you can see here in the short term, the risk is that we can move back lower. A couple of the reasons why the Australian dollar has underperformed this year has been, first of all, China has underwhelmed in terms of its growth profile. And second of all, Australian interest rates remain below major trading partners, most notably in the US, where interest rates are around about 5.4%. In Australia, interest rates are about 5.35%. So that's kept a lid on any Aussie dollar gains. We've had a very strong rally over November, but in recent days, we tend to have seen quite a significant turn lower in the Australian dollar. So you can see now our year-end target for the Aussie US is at 64. Where we are now at 66, or just below 66, is at a premium at our forecast. You can see as we look further into 2024, we do expect to see the Aussie dollar start to rally, particularly as Boris mentioned, other central banks start to cut rates and Australian interest rates remain high. But for now, the short-term risk, according to this, our latest forecast published in our Global FX Outlook, the risk is for the Aussie dollar to drift back lower. In the Kiwi, the New Zealand dollar had a big pop last week. And similar to what we've seen from the Reserve Bank of Australia, remember the RBA raised rates in November, one of the few central banks to do so. Well, the Reserve Bank of New Zealand didn't raise rates, but they certainly talked tough. And they indicated that there's no expectations that the Reserve Bank of New Zealand will be able to cut rates next year, and says that inflation still remains a real problem. So both Australia and New Zealand seem to be having an issue with inflation remaining more sticky, particularly in the services part of the economy. So that could be a real defining theme as we go into 2024, and can provide some support for both the Australian dollar and the New Zealand dollar. But for now, like we saw on the Aussie dollar, in the short term, the risk for the Kiwi US is a move back lower, and our year-end target is at 60 cents for the Kiwi US. One of the big changes we saw in November was a sudden burst of strength in the Chinese yuan, and two big factors drove that. First of all, we saw some better data from China, particularly around the industrial production, retail sales, fixed asset investment, and those data points seem to indicate that some of the support the Chinese government is trying to provide the Chinese economy is starting to help. Now, we've said on numerous occasions in these presentations that we do not expect to see Chinese growth going back to what we saw in the 2000s or in the 2010s, that 10% growth. But the Chinese economy can settle around 5%. And if it does, that's going to provide support to the Chinese yuan. We're starting to see a recovery in China. It's slow, it's steady, but it does seem to be occurring. And that's suddenly providing some support for the dollar CNY. And of course, we started November up at 730. We're now starting to roll back lower. We're around that sort of 715 now. You can see our forecast is certainly as we look further into 2024 is for a move further lower back towards that 7 level by the towards the end of 2024. So a stronger Chinese yuan looks more possible, and it's a possibility when you consider that 730 level has been a real line in the sand for the People's Bank of China pushing back against that Chinese yuan weakness. So it seems to indicate that for now, RMB buyers not really looking for a move up towards 730 anymore, maybe looking 715 to 720. In the dollar Sing, just to wrap up our APAC analysis, that's a market that's been really performing strongly in line with the weaker US dollar, moving back down towards 4-month lows. Again, we think that if we do see a recovery in the US dollar, that can help the dollar Sing to push back higher as well. So the dollar Sing has been trading in a range between 132 and around 138 for all of this year. You might remember we said earlier the trading range for the dollar Sing very small this year. We expect that range to continue, and with us now down the bottom end of the range, it seems like we've found some support and likely to push back higher. So again, a move up towards sort of that 136, 138 level is the target for the end of the year. Okay, let's have a quick look at some other regions away from APAC, particularly for the North America call. So update for those regions. And of course, we already mentioned the US dollar sharply lower, 4-month lows versus a whole basket of currencies. Where we're seeing the US dollar in the most volatility last month was versus emerging market currencies. We saw a big recovery. We already mentioned the Chinese yuan was stronger, but some of the other markets, the Malaysian ringgit, the Vietnamese dong, but more specifically in North America, the Mexican peso had a strong move to the top side that we've seen more recently. Certainly, volatility has been higher. So the Mexican peso stronger, the dollar Mexican lower, and you can see it right down the bottom end as those emerging market currencies, including the peso, stronger as well. Also saw the euro come back quite strongly versus the CAD. The Canadian dollar's been, while it's been stronger versus the US dollar, and it has seen a pickup in line with what we've seen in some other markets, it's been a bit hamstrung. It's underperformed as a result of that weakening oil price. And so a weaker oil price has kept the Canadian dollar as a bit of an underperformer. So while the dollar CAD has been lower, moving back to around that sort of 135, 136 level, it hasn't fallen as much as we've seen some of the other commodity currencies pushing higher. So the Aussie dollar, for example, strong performer. The Canadian dollar underperformed as a result of that weaker crude oil price. And you can see that here with some of the key North American markets. While a lot of other currencies have managed to perform stronger, the dollar CAD here only certainly has fallen, but still remains above its all of its long-term average, and that's just a sign that the Canadian dollar does remain broadly weak. If it was really outperforming, then we would have seen that move into the purple zone that signals some Canadian dollar outperformance. And again, like we said, with the Mexican peso stronger, the dollar Mexican peso right down at the bottom end of the range. As we look at what we're looking at here in terms of some of the key US dollar pairs away from APAC, the pound seen probably in a relatively good space here, up around that sort of mid 120s, and where the outlook is for the moment, that range you can see from between about 120 to 124 over the next 12 months. So the pound might not see any more substantial gains. Like Boris said, most of the major central banks are expected to really be on pause or potentially cut as inflation comes down, and we're seeing that in the British pound. But that said, the pound has suffered from more sticky inflation. Some of the impact around employment and Brexit have kept inflation higher in the UK than some other markets. So broadly for the moment, we see the pound well supported around current levels. The euro, on the other hand, might start to drift back lower. We mentioned earlier that inflation had come off quite sharply. Some of the growth profiles looking around Europe look more underwhelming, particularly if you lump Eurozone growth versus the US growth. The US is clearly outperforming. And then Germany, of course, continues to suffer from this slowdown in China as well. So the euro seen as a little bit more underwhelming looking to the future. And the dollar CAD, like we say earlier, it hasn't been able to benefit, hasn't been able to fall to the extent that we saw US dollar fall versus other markets, really because of that oil weakness, but a bit more oil strength, and more broadly, the oil price is expected to stabilize. Once that happens, then the CAD can start to strengthen, and you can see here the overall view as we sort of look further out is for the dollar CAD to start to drift back lower. So that's what we're looking for at the moment. It's been a really strong move across financial markets over the last month as the US dollar fell, and that's providing real opportunity, particularly for your US dollar buyers based out of Singapore, Australia, New Zealand, Canada. That US dollar weakness has been a real opportunity. But our concern is that after a very sharp fall, maybe the market has overreacted to expectations that the Fed is likely to be on hold, and particularly maybe we're not going to see 5 rate cuts from the Federal Reserve next year. If we don't, or if markets start to come to that belief that we're less likely to see those rate cuts, then the US dollar might rally. And again, that's why we said our view for the end of the year on the Aussie US is back towards 64 before we start to see a rally towards the end of this year. So, of course, end of next year. And so, of course, this is what we're trying to do with our clients, is to really to make them think about the ways that they can better understand currency volatility, and by using that understanding to put risk management in place. Understand the risk that geopolitics can play going into 2024. We've seen a number of unpredictable geopolitical events, Ukraine, Gaza, going into 2024. What will happen with the US presidential election? There's a whole range of issues that could drive volatility in markets. Like we saw in Ukraine last year, that rapid response of sanctions made doing international business more complicated. We can help with this as well. So that's the view from here at the moment. After, like we say, a year that has been, if you look at the raw data, less volatile than usual, doesn't necessarily feel like that. We've had a number of big pivots in expectations of perhaps the Fed would cut, perhaps they'll need to raise more. We had Silicon Valley Bank, we had the geopolitical crisis through the Middle East. While it has been a lower than usual volatility year, we have seen some big moves and big surprises, and we certainly expect to see that further going forward. Before we go, we'd like just to take some time for some questions, and we'll open the floor to questions now. Like I say, we do have the Q&A tab there on the Zoom controller. So if you have any questions, please feel free, and we're happy to cover those in more detail. I got a couple of questions here, and I might go to Boris first. But Boris, your talk about central banks and the potential to cut next year has generated some excitement. In your view, what central bank is most likely to cut next year? Which bank will be first to cut next year?
Yeah, thank you, Stephen. I think it's an important question, probably the most important one in this context going into 2024, because as we previously said, the inflation and kind of the monetary policy outlook are the key drivers of FX volatility at the moment. And getting rates right, getting inflation right means getting FX right. And for us, in the context of the forecasts, what we are expecting is, given the weak economic profile of the Eurozone and inflation falling to really close to target level in Europe, we're expecting the ECB to be the first one to initiate this global easing cycle in probably the first or second quarter of next year, given our expectation that inflation will fall below target at the middle of next year. And then the second one would probably be the Fed. We'll still see this economic weakness in the US economy going into Q1 and Q2 next year. And because of this, we are expecting the Fed to cut after the ECB, maybe 1 or 2 months after the ECB. And then there is also the Bank of England, on which markets expect 3 interest rate cuts next year. I think we are pretty comfortable in the view of getting 2 or 3 cuts as well, given that inflation will continue to fall. And then on the other spectrum, of course, is the BOJ, who is expected to increase rates for the first time in decades, and the RBA, which is not expected to cut in 2024. And this is, I think, important, given that I said that markets are assigning this hierarchy within G10 central banks. They're trying to figure out who is going to cut first. And looking at this and looking at the outlook, they're trying to gauge which currency is the most likely to appreciate. So in this context, again, the ECB followed by the Fed and the Bank of England. And on the other end of the spectrum, we have the BOJ and the RBA probably staying put.
Great. Thanks, Boris. I did actually get a question as well, just because we just had the Reserve Bank of Australia decision come out in the last half an hour. So did just get a question about the update from that. And the Aussie actually did fall quite sharply, about 0.5% after the decision. The RBA did say that they would keep rates on hold. There was about a 10% chance going into the meeting for a rate hike just in the last couple of minutes before that decision. But the key takeaways from that decision really did indicate that there's no real significant sign, like you say, Boris, that the RBA is currently considering cutting rates, and that is probably likely to provide more support for the Aussie dollar going into next year. In particular, they said that while households are starting to struggle, they continue to really say that those signs of stickiness in that supply and services inflation is really keeping their focus on inflation. So like you were saying about the Eurozone, quite stark now to look at the most recent result from Eurozone inflation at 2.4%. And in Australia, the most recent inflation was 4.9. So it really is showing you that Australia is in a different category at the moment, and that might be able to provide some more support for the Aussie dollar. All right, well, that brings us to the end of the presentation. Boris, I'd like to thank you again, not just for this presentation, but for having presented to the APAC customer base on a number of occasions this year. We really appreciate your insight. It's been a great addition to the monthly market updates that we provide our customers. So thank you. If you have any questions or comments, please feel free to reach out to your Convera representative or contact us at the email there at currencyconvo@convera.com. I'd like to thank everyone again for coming to these webinars this year, and we look forward to helping provide further insights around foreign exchange and macroeconomics as we go into next year. Thanks again, and all the very best. Thank you. Bye-bye.